As you said that the space is new, but I was also reading this one report, as I mentioned, that was from Palki, and she was mentioning that at this moment the startup ecosystem is struggling. The fundings are down by 75%. I
Yes.
think last year it was somewhere around $11.8 billion. The first quarter startups raised that much amount, but this year it's 2.8 or $2.9 billion in the first quarter. So how do you view this in the climate space? Because the funding come ho rahi hai. Why is it that the investors are tightening, the money, or like why is this happening?
Uh, See, obviously, we all know about the macros, which are sort of leading to this crunch or the so-called funding winter. Um Definitely the Russia-Ukraine war, the slowdown in the European and US markets, or UK for that matter. The global economy, the global macros are definitely, the sentiments are down over there. And for that reason, a lot of sovereign funds that usually take large positions in emerging economies like India, China, Brazil, that's sort of coming down a little bit. And when that comes down at that scale, it funnels down to choosing the most safest investment. And so far, the safest of investments historically, we've seen, there are a bunch of software companies, a lot of fintech, and subsectors of these two largely, which gets the first preference in terms of getting funded, and then climate sort of gets relevance over there. I have to agree that there is definitely a struggle right now in terms of a lot of founders, not coming out with enough conviction and saying that, look, let me build this right now. There is a time, there is a place for everything. But folks who actually take the leap of faith right now to build it, I think the best time to curate a fundamentally business right model is the time right now. There hasn't been a better time because valuations have corrected. There are a lot of meaningful investors who say that if the valuations are right, if the founders are right, if the markets are right, and we foresee an outcome, or we foresee that the founders will be able to build something over the next 18, 24 months, let's go for it. Uh, to a certain extent, uh, concepts of dilution, and valuation and all of that, that's fairly compromised at the moment. But I think looking at the larger picture for both investors and founders, it's an opportunity, I would say. And if entrepreneurs are ready to take the plunge right now, I think it's the best time, like I said.
And as you said that, valuations have been corrected. Do you feel that now is the time not for valuations but for profitability? Because we see so many unicorns with so valuations, but these are actually loss-making businesses. So what according to you is a fundamentally strong business? And if any, say, startup founder is listening to us right now, what would be your advice to him or her?
See, it would be unfair to the unicorns that already exist right now to say that, look, they haven't built any business, because some of them are, outright game changers. Global unicorns like Uber or Slice. I mean, folks like them, they have completely changed the landscape of, shared mobility and the fintech industry altogether. To expect startup founders to be profitable from year one, year two, even brick and mortar traditional businesses cannot be profitable from the first couple of years. And especially if someone is building on an idea, that idea takes multiple iterations, it takes multiple experiments, soft pivot, hard pivot, to actually arrive at a model which works. And in our VC world, we call it PMF, or product market fit. So unless that is achieved, it's unfair for founders or for investors to say that, look, be profitable as soon as you start. It's not possible. Any businesses require at least 1,000 days to prove themselves, to get some leeway into the entire, whether it's building out a product, building out a service, catching hold of the first 100 customers, and then to make sure that these customers keep coming back again to buy, your service or your product, it takes a bit of time. To circle back to your question, whether founders should uh, compromise on their valuation, I think they should. It has to be a balance, and it has to be a balance of expectations on both sides. If there is some way or form where investors and founders can say, let's come to an arrangement where you hit a certain milestone and it's good for both of us. We build a clawback in the agreement where you get to gain back your equity on hitting a certain milestone. That gives so much more confidence on both sides, and it's a win-win for both. But at the same time, due to the current climate itself, there are a few investors who will ask for some sharky terms, and at the same time, infuse that millions of dollars into the business. I think it's ultimately the founder's call to decide whether they need the capital at this time, or maybe do a short bridge or do an internal round right now. Manage with your internal investors for now, sort of tied through this next 3-4 quarters until things improve. Bridge rounds are trending. Hashtag trending. And I think that's sort of the in thing right now. And if they are able to build this bridge onto their Series A, Series B rounds, I think that'll be a wise move.
Please expand what a bridge round is.
So a bridge round typically is anything between a pre-Series A or a seed fund to the next round. So, suppose a founder is has a runway for the next 8 months and has figured out that they need more money to grow right now, and obviously some insurance money to make sure some contingencies are taken care of. A typical bridge round would then mean that extension of runway of that 6-8 months to perhaps a 18 months or a 24 months, until they are able to attract interest of the next round investors. So basically, it's a safety net both for the founders and the investors to make sure the business does not suffer. Customers, keep coming back. The product development does not suffer. I think bridge rounds are extremely helpful to tide over situations like this. The slowdown that you're seeing right now, and founders so far have been able to tide over it quite successfully. Unfortunately, there are also many deserving businesses which have not been so lucky. But at the same time, it's a way of life. You hit some, you miss some.